Sydney home values just fell 1.2% in a single month. Melbourne dropped 1%. That's the biggest monthly fall in the national index since December 2022. So every second person is now asking me this same question. Should I wait for the bottom? Here's the uncomfortable truth. Last cycle, the people who waited for the bottom are the people who missed it. Because the market bottomed while rates were still going up, and by the time it felt safe and cozy, prices had already run up 8%. Now, in the next 10 minutes, I'll show you the actual data, not vibes, not headlines, and give you a straight answer. Good day, everyone. My name is Ahijith. Call me AJ. I'm a co-founder of Handle Properties. We're a buyer's agency and we buy roughly $10 million of investment property every single month for our clients. And this isn't just theory for me. This is the exact question that decides real money every week. And look, I get the instinct. Nobody wants to buy in May and watch the prices drop by Christmas. But should I wait for the bottom assumes two things. One, that there is actually a bottom coming. And two, that you will be able to pick it. Now, the data says both assumptions are fairly shaky. So here's the plan. First, what's actually happening right now, because it's weirder than the headlines actually indicate. And then let's look into what the history says about picking the bottom. Then my actual recommendation, including what would change my mind. First thing the data tells you, the Australian property market doesn't exist. Right now, there are three completely different markets running at once. Market number one is Sydney and Melbourne. Correcting, over the June quarter, Sydney fell 3.2% and Melbourne fell 2.6%. Cotality, that's CoreLogic's new name, literally titled their research, Sydney and Melbourne navigate the early stages of a downturn. Then we have market two, the mid-sized capitals, still breaking records. So while Sydney was falling, Brisbane, Adelaide and Perth kept hitting record highs. Perth up about 25.8% in the last year. Melbourne up 0.5%. That's a 25 percentage point gap between capital cities in the same country under the same interest rates. And then we have market three, rentals, on fire everywhere. National rents rose 5.7% in the year to March. Every single capital city has vacancy rates under 2%. Renters are now spending a record 33% of their gross income on rent, the highest ever recorded. So when someone says, I'm waiting for the market to bottom, my first question is, which market? Because Brisbane isn't waiting for you. Quick context, because it matters for the wait decision. 2025 was a boom year. National values rose 8.6%, the strongest calendar year growth since 2021. And that added about $71,400 to the median dwelling price. Rate cuts kicked in February 2025 and the market ran hard. Then inflation came back. The RBA has raised rates 3 times, taking the cash rate to 4.35% in May. And the vote was 8-1, so they weren't kidding around. The Middle East conflict pushing up the fuel prices is feeding straight into inflation. Higher rates, less borrowing power, and the most expensive, most debt-sensitive markets, which is Sydney and Melbourne, correct first and the hardest. That's not mystery, that's simple mechanics. The next RBA decision lands on August the 11th, and that's the swing factor. Now, let me argue against myself, because if I can only give you one side, I'm a salesperson, not an advisor. The case for waiting is real. Sydney and Melbourne are falling right now, and June's 0.4% national decline was the sharpest month since December 2022. If RBA hikes rates again in August, borrowing capacity shrinks further, and those declines are likely to deepen. Nobody with a straight face can tell you Sydney bottoms next month. So if you're buying in Sydney or Melbourne with the 2-year horizon, yeah, then you're probably right. Patience is the right strategy. But falling markets reward slow buyers with negotiating power. And this is where most commentary stops. Waiting is not free. And that's what the next section is all about. So 3 pieces of data. This is the core of the video. 1. Last cycle, the bottom was invisible. Between May 2022 and Jan 2023, national values fell 7.5%. Everyone was waiting for this crash to continue. Instead, the market bottomed in Jan 2023 and rose 8.1% over the calendar year to 2023, whilst the RBA was still hiking. The first rate cut didn't arrive until February 2025, 2 full years after the prices had bottomed. So if your plans were wait for rate cuts, then buy, you paid an extra 8% for the privilege of feeling safe. The bottom is only ever visible in the rear view mirror. Secondly, the supply problem isn't getting fixed. The government's own advisory body, the National Housing Supply and Affordability Council, forecasts 938,000 new homes this accord period against 1.2 million target. That's 262,000 homes short. We approved just under 186,000 homes in FY 24 to 25. The target needed to be 240,000 a year. Prices can wobble quarter to quarter, but a structural shortage puts a floor under the medium term. The floor is why the 2023 crash lasted 8 months. 3. While you wait, you're paying rent into the tightest rental market on record. National vacancy is sitting at 1.2% on SQM's numbers, 1.6% on Cotality's. Either way, it's brutally tight. Say you're renting at the Sydney median of $824 a week, whilst you wait for a year to bottom out. That's roughly 43 grand in rent that has gone. So, for that bet to pay off, prices need to fall more than 4 to 5% on $1 million purchase. And you actually need to pull the trigger at the bottom, which C.1 is almost impossible for most people. Now, we're not saying buy in Sydney, you can buy in much better markets out there, but if you get that right, the decision to buy now or wait to the bottom is simple. My honest answer, I think the whole question is wrong. The right question is buy what, where. So if you're set on Sydney and Melbourne blue chip, you don't need to rush. You are in a falling market, use it to negotiate hard, lowball with data, and let motivated vendors come to you. Buying now in a downturn means buying well, not buying fast. But if you're an investor whose goal is growth and yield, the data points away from the falling markets towards the tight ones with sub 1.5% vacancy, rents compounding, record high demand, and structurally undersupplied. That's where our research keeps landing for clients. And it's why the average across our purchases last year were around 22% capital growth across the calendar year of 2025, with 7% plus rental yields on most purchases within 3 to 5 years. And those weren't coming from Sydney or Melbourne. They were coming from different markets. And roughly 59% of those deals were actually off markets. One more thing, because trust matters more than views. Here's the one thing that would change my mind. If national vacancy rates climbed to 2.5%, if unemployment breaks materially higher, or if the RBA signals a long hiking cycle in August, the don't wait case weakens, and I'll make a video on that too. That's the deal with being data-driven. The data gets to overrule me as it changes. So if you want an answer to your situation, your budget, your borrowing power, your timeline, that's literally what we do here every day. So we're the only buyers agency in Australia that backs the research with the capital growth guarantee, and the first chat is free. The link is in the description. If this is something that would be useful to you, subscribe. I make one of these videos every time the data says something that the headlines do not. And drop a comment. Are you buying, waiting, or stuck in between? I read them all, and I'm looking forward to seeing you in the next one.